Perhaps the most challenging part of building a merger model is understanding all the adjustments that occur because of the accounting rules associated with acquisitions. So first of all, understand that FASB prescribes that we use what's called the acquisition method to account for acquisitions, and here we've included the rulings that govern the acquisition method. There's much alignment between US GAAP and IFRS. In other words, the accounting rules are generally quite similar. So everything that we go through here in this course is applicable both to IFRS and to US GAAP. And the main premise governing the acquisition method is that the acquisition is viewed as the purchase of target assets and the assumption of its liabilities, all of which are written up or technically down to reflect their fair market values. Just bear in mind that writing up assets to fair market value is not something you can normally do. If a company sort of hums along, you can't just normally write up its assets to what you think they're worth. It's only in the context of an acquisition that you can write up things like PP&E and intangible assets to reflect fair market values. And that's because of the conservatism principle and the historical cost principle, which says that if you're just operating a business, you can't just write up assets to whatever you think they're worth. But if there is a buyer that's now acquiring this business, you can write up the assets to their fair market value. The one other important critical piece of acquisition of the acquisition method is that if you purchase a company with a purchase price that's greater than the fair market value, the now written up value of all the assets net of liabilities, that excess, that incremental purchase price is recognized as an accounting asset plug called goodwill. The easiest way to make sense of this is with some examples. So let's just dive into the basic premise here. And sort of the allocation of that purchase price onto the assets is something called purchase price allocation. So purchase price allocation represents the process of getting from a pre-deal target balance sheet to a post-deal target balance sheet. And it actually assigns a sequence of steps that you have to go through in the process of allocating that purchase price. So what does that mean? Step one, allocate the purchase price to the target's tangible book value. And under US GAAP, the tangible book value is defined as actually all the assets net of all the liabilities, excluding one specific asset, which is the target's pre-existing goodwill. Not the new goodwill created in the deal, but any pre-existing goodwill. That's called tangible book value for the purposes of purchase price allocation. Then you write up the assets net of liabilities to fair market value. And if the purchase price is still greater than the fair market value, the excess is then allocated to goodwill. Here's sort of a visual representation of this. Let's say the tangible book value of the target company is $45 and the fair market value of the book value of all the assets net of the liabilities is 60. So we write up the book value by 15 million to get up to that 60. And now if we purchase the company, if the acquirers purchase the company for 100, there's an excess of 40. The purchase price is about $40 greater than the fair market value of the equity. And so that's the basic process. And now let's go through that. Actually, before we go through that in an example, just a couple of thoughts here. Since many assets are commonly carried at below fair market value in the target balance sheet, like PP&E, intangibles, LIFO inventory. If you're wondering why would LIFO inventory be carried below fair market value, well, LIFO is last in, first out. That means that the remaining inventories are actually old in periods of rising prices, which is sort of typical. You're going to see inventories that are undervalued, and so an acquisition actually creates an event that merits the writing up of inventories under certain circumstances. PP&E, of course, is probably a little bit more intuitive. You have things like buildings and land that have, specifically land, you can imagine, that is rising in value all this time and isn't being reflected up until the acquisition. Same with intangible assets, brands, patents, things like that that might be sitting grossly undervalued on the balance sheet now get to be written up. So in terms of mechanics in an actual deal, you're not really going to know what the amount of write-ups are when you're doing the modeling. Actual appraisals are actually conducted at later stages of the deal. They often long after the initial analysis is required. So practitioners often just estimate the write-ups by applying some sort of industry percent or simply ignoring write-ups entirely, which is why a lot of times you'll have practitioners mistakenly tell you the goodwill represents the excess of the purchase price over the book value of assets as opposed to the excess of the purchase price over the fair market value of the assets. It's basically because they're ignoring the write-ups because they don't know what they are until later stages in the deal. Let's go through a simple exercise. It's going to make this a whole lot clearer, I think, for those that are seeing it for the first time. So here we've got a deal. The purchase price is $1, and let's keep this in millions. So you got $1 billion purchase price. So yeah, let's say in millions, just so we can keep the language consistent. So you got $1 billion purchase price. You have $400 million in fair market value of PP&E, and here is the pre-deal target balance sheet. So on day one, you're looking at a company has cash of $100 million, PP&E of $300 million that we know has a fair market value. The appraisers come in, for example, and they determine it's not $300 million, it's $400 million. And you have some pre-existing goodwill from presumably prior acquisitions that the target had made, not the acquirer, but that the target had made, and it's just sitting on the books at $50 million. You also have 0 deferred tax liabilities. You'll see why we have to deal with that in subsequent videos. Let's say you have 0 right now, keep it simple. Debt of 50 and the remaining being the equity value. So assets equal liabilities and equity. And now, how do we apply the purchase price allocation sequence to get to what the new balance sheet for the target, what the new target balance sheet looks like? And again, ultimately, the goal for us is to get from a pre-deal balance sheet to sort of superimpose the purchase price onto that balance sheet. So we get to a new target balance sheet that is sort of the post-deal balance sheet. And this is what we actually combine, what we add to the acquire balance sheet when we build our model. So in order to build our model, we have to sort of apply the purchase price to the target balance sheet. So let's go through the sequence of steps that are prescribed by FASB. First, we eliminate existing goodwill. So if we eliminate existing goodwill, we basically pretend like that doesn't exist. We get to a tangible book value. If we were to sort of stop right there, we would see that the tangible book value of this business goes from equity of 400 to 350 because you now have $50 million less of assets than you did before. Now, FASB prescribes that because ultimately this is a accounting plug from prior acquisitions. We're trying to find out what the new goodwill is, so let's start from scratch and eliminate any prior accounting plugs. Presumably this will get wrapped into, if this is still, if prior acquisitions were worth whatever they were worth, then the new purchase price will presumably reflect that and we'll capture that in the new goodwill. That's the sort of logic of the sequence of steps here. So that's step 1 is accomplished. Again, the main takeaway here is that if you credit goodwill, you eliminate goodwill, there's a corresponding debit on the equity side. This is step 1. Step 2 is we adjust to fair market value. Well, here we're keeping it simple. The only asset that the company actually has other than cash or goodwill is PP&E, and that has a fair market value that's $100 million greater than the current carrying value. So we're going to add $100 million. It's going to be a debit to PP&E, and what's the corresponding entry? Well, it's going to be a credit to equity. If you now all of a sudden have property, plant, equipment that is $100 million greater than what you thought it was, well, you have more equity than you thought in the business. The final step is to allocate the excess of the purchase price over the fair market value of the balance sheet. At this point, now that we've completed step 1 and step 2, understand that we've only allocated 400 minus 50 plus 100. We've only allocated 450 of this $1 billion purchase price. And that's the way to really look at it. You can almost think about it by starting this way. The new target balance sheet, by definition, has a new equity value of whatever the purchase price was. Right? So if you bought the assets net of the liabilities of a company for $1 billion, the purchase price allocation exercise is this process of getting the new equity to reflect that new purchase price. And so you can actually just sort of back into this. This means that goodwill, that equity has to go up by an incremental 550, right? To get to 1,000, you go from 400 minus 50 is 350, plus 100 is 450, plus 550, that's $1 billion. The offsetting entry, the excess of the purchase price over the fair market value of the target net assets is this goodwill. And so now we can complete the new target balance sheet. It's sort of informed. Cash, of course, doesn't change. Cash is very rarely written up or down. Cash is cash. PP&E becomes that 400. Goodwill is now 550. We add all that up and we get 1,050,000,050 in assets, 0 in DTLs, deferred tax liabilities, and the debt is passed through. The debt is assumed. So the total liabilities and equity, our model is in balance, or our analysis is in balance. And this is the basic purchase price allocation exercise. Okay, what we've gone through here is the most simple sort of, and yet critical sort of conceptual bit of how you allocate the target, how you basically go from a pre-deal target balance sheet to a post-deal target balance sheet. Okay, in the next video, we are going to now sort of peel the onion a little bit further, add some complexity to this purchase price allocation exercise, and start talking about some tax issues that emerge in a deal. This is going to be fairly complicated stuff, but we're going to try to go through it fairly slowly, and hopefully it'll make a lot of sense.